From Kentucky, Chair of the Monetary Policy and Trade Committee, Mr. Barr, recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks for hosting this very important hearing about the de novo charter drought in the aftermath of the Dodd Frank law. According to the Kentucky Bankers Association, which I represent, the number of banks in the Commonwealth of Kentucky has dropped from 198 to 164 since the enactment of Dodd Frank. That means that roughly 1 in 5 banks that existed prior to Dodd Frank has closed its doors. And contrary to Ms. Edelman's testimony, at least in Kentucky, I can tell you that most of this decline occurred not in the immediate aftermath of the financial crisis, but instead in 2013, 2014, 2015, and 2016, well into the implementation of the qualified mortgage rule, the TRID rules, and implementation of Dodd Frank regulations. Now, we know from Mr. Burgess's testimony earlier today that Kentucky isn't the only state that has this problem in terms of the decline in community banks in this country. Ms. Edelman and my friends on the other side of the aisle, with reference to their slide that is on display here, they are blaming this decline in new banks. They're blaming low interest rates on this, monetary policy. Ms. Edelman's testimony is that 75 or 80% of the decline in new banks can be explained by low interest rates and weak macroeconomic factors. I just have to note, as the chairman of the Monetary Policy Subcommittee, that my friends on the other side of the aisle are blaming unconventional monetary policy for macroeconomic trends in this hearing, but in the other hearing, in my subcommittee, they credit unconventional monetary policy for positive economic developments. So I don't know which one it is. I don't know what their narrative is, but here's what my community bankers tell me. What my community bankers tell me about this chart and Ms. Edelman's testimony is that if you're a good banker, we know how to work in a low interest rate environment. We know how to adjust our rates to reach the margin and the spread that we need to be profitable. What is different, though, now, that coincides with this trend from 2008 and 2013 with the decline in new bank formation is the Dodd Frank law. The low interest rate environment is not to blame. A community banker who was in my office today from Central Kentucky told me that his bank, his net income, the profits of his bank are down $8 million a year, year after year, since the Dodd Frank law. So this idea that low interest rates are the cause of the decline in new charters, the decline in banks, just doesn't hold water. This trend coincides not just with low rates, which good bankers can deal with. It coincides with the Dodd Frank law. So I'll just ask Mr. Burgess to respond to that. Do you agree with that analysis?
Yes, I do agree with that. We as bankers have always go through different interest rate cycles, and we have to manage our balance sheets in a way that we can appropriately deal with that. The difference this time is that our regulatory cost is significantly higher. It makes it much harder to reduce the cost side of the income statement to be able to adjust to those changes in interest rates.
Now, my friends on the other side of the aisle also, and Ms. Edelman makes a big deal about the fact that Dodd Frank law is tailored, and they say that there's exemptions from some of these regulations for small banks. According to Kentucky banks, what they say is the most time-consuming and burdensome regulations are the real estate disclosure rules, fair lending regulations, ability to repay, QM rule, TRID, and that these regulations are doubling the amount of time required to close a mortgage, even assuming disclosure contains no errors. Now, Ms. Edelman makes the argument that there's a small creditor exemption on QM. Tell me why the small creditor exemption is insufficient to deliver the relief to a community bank, Mr. Burgess.
Well, let me just tell you our experience. Before we started implementing the Dodd Frank rules, our bank was making about $220 million a year at our peak in the 4 markets that we serve. We had to go back and retool our entire mortgage lending process. We are just now getting back up to about $80 million a year, so we're less than half in mortgage loan volume than where we were before we started implementing all the new rules.
Thank you for your testimony. My time has expired. I yield back.
Gentleman's time has expired. With that, we go to the